Welcome back to our channel. Thank you so much for joining us. For those of you that don't know who I am, my name is Alex Hughes with the North Pacific Homes Group here in Victoria, and I've got such a great video today. I will be interviewing Daniel Foch. He's the Chief Real Estate Officer for Valery.ca. And I came across one of his TikTok channels, and what I like about him is not only the wealth of knowledge that he possesses, but the fact that he's so data-driven and analytical. So in today's interview, we go over such a wide variety of topics, such as the Bank of Canada interest rates and what new data he's looking at to help give an idea of what real estate trends are coming. Now, he's based over in Toronto, and of course the Victoria and Toronto market are acting very differently from each other. So I left that conversation learning so much, and I hope you do as well. And if at the end of this video, if you liked the video, give us a like, please, and subscribe to our channel. Well, I hope you enjoy. First off, I just want to say thank you so much for agreeing to do this video with me. Like I said, I found you on TikTok and I absolutely love your content. What I love about it is the fact that it is so data-driven and analytical. So again, appreciate your time. Wanted to jump into things here. Obviously, I'm based in Victoria. You're based over in the Toronto market. But what's a myth or misconception you often see people believe about Canada's real estate market? But what does the data actually tell us?
I think the biggest myth is that home ownership is an investment. Whereas, really the primary advantage to home ownership is that it forces people to save money and store that money in a hard asset. And most Canadians, like data would tell us that most Canadians aren't exceptionally good at saving money and we're not exceptionally good at investing. And so I think that that's really the real value of homeownership, is that it gives us the ability to save and the ability to invest and be prudent about investing. Not it isn't in itself a great investment. I actually think, if you were to just dollar cost average if you were to rent and dollar cost average every difference, or dollar of difference that you would have paid being a homeowner, so like maintenance costs, down payment, interest, taxes, etc. If you just put that into the S&P 500, you would be way ahead, like significantly ahead. But the truth is, like, most of us who rent aren't dollar cost averaging that extra $1,000
Right.
or $2,000 a month into S&P 500 each month. And that's why home ownership is a good thing for Canadians.
Right. Okay. So that's great. I appreciate that. Why do you think that the Vancouver and Toronto market is getting hit so hard while other markets such as mine and Victoria, which yes, we are having some slight decreases in our condos, but still holding relatively okay. But why do you think they're getting hit so hard while other markets seem to be doing all right?
I would say the big reason is that it's all relative to debt, right? So um, people who took on a lot of debt in markets where they had to because prices were going up so substantially, especially Toronto and Vancouver, they ended up in positions where they had mortgages that are harder to service and they had lower loan to value and they took on more debt. And as interest rates rose, they were more sensitive to that interest rate environment. And they also probably were carrying bigger mortgages. So as the cost of living rose and inflation rose, they were more sensitive to changes in that environment as well. So I think that that's really the primary reason. And Victoria, I mean, it's been seeing a little bit of a downturn, but not as substantial as Toronto and Vancouver. And the reason is because prices didn't run up as substantially and people didn't have to chase those prices up
Right.
using debt.
Right.
So it really is 100% relative to the credit activity that was required.
Right. Right. Okay. Yeah, like I said, for us, we've seen a little bit of a slip, but in comparison to Vancouver, which is right across the pond, we're doing okay. And actually, we're starting to see for Victoria specifically, the percentage of off-island buyers is getting bigger and bigger each year. Last year we were just over a third, and that largest buyer pool is coming from the Lower Mainland, and we're starting to see people coming from the Lower Mainland, from Toronto, from Calgary, all manifest destiny coming out west, which I think is
Yeah.
protecting us because we have such an off-island demand. Toronto is a huge and segmented market, of course, and you've done a lot of content on condos that are in a free fall, and the
Mhm.
detached market's under pressure. Do you have, or if you could pick one lesser followed submarket in Toronto, or maybe the outskirts, and many people are maybe ignoring it this time, but are showing promise? And what is it? And do you have any data points that could support this pick?
Well, I think a lot of your like 705 markets in so the way the GTA kind of works is you've got like the 416, which is your core Toronto, and then you've got the ring around that is like the 905. And then
Hmm.
outside of that ring, there's the 705. So you'd start to see markets like Barrie or Peterborough in the 705 region. I think a lot like those markets corrected so violently during the interest rate hiking cycle. They had tons of buyers rush out during COVID. People were, moving to them because they were nicer places to live. They had bigger houses. They were cheaper. Home values, doubled in most of those markets during the pandemic as a result of low interest rates, but also as a result of buyers moving to smaller markets outside of the city that were accessible by like transit or highway to get back downtown Toronto if you had to work 1 or 2 days a week. But prices have come down like 30, 40, 50% in some areas in the 705, especially in cottage country as well, to the point where like, is there a lot more downside risk in those markets? I mean, there's probably a little bit for sure, but not a massive amount. You're certainly further from the top than you are from the bottom. And so I
Right.
think that and if you start looking at them, I mean, most of my buyers are investors. If you start looking at it from an investment perspective, you are starting to see some cash flow and some yield potential in markets like Barrie and Peterborough, just as an example, because they're the two largest cities where you could actually buy a property where the cap rate is above your cost of capital, right? Above your the interest rate that you would use. So
Right.
to me, that's an investment that might be sensible in today's
Right.
market.
Yeah. Okay. And similar to Victoria, I mean, we obviously on a much smaller scale, we have the West Shore communities, Langford being one of them, which was the fastest growing city in Western Canada. And for
Nice.
us, pretty much, and I'm sure with every single market, it's, the further out of downtown you are, and when I'm talking West Shore and out of downtown, it's 25-minute drive. Those larger those boom and busts are going to be, right? So obviously prices, when you talk about the single family detached, obviously Langford and Souk has had the biggest drop. But now it's starting, because we've had that drop and the prices are seeming to plateau, it's allowing people to get into a brand new build, 2,500 square foot with a one bedroom suite for 1.2, whereas that same house in kind of Sanitron, one of the core is a minimum of 1.8, right? So a pretty fairly substantial price difference, but allowing those people to get into the market. Um, Now, I said this at the beginning, one of the reasons why I asked to interview is because you're one of the few people that actually really focuses on the data. But that being said, even data can be limited. And what do you think are the biggest blind spots or risks you've seen relying just on the historic metrics, sales, inventory, days on market? And what emerging metrics or signals do you wish that people were looking out more?
It's a great question. I think that the big thing that gets missed in data is that like your average consumer really doesn't care about the data. And so your consumer sentiment in many cases is very detached from what's happening in prices, in number of sales, et cetera. Yeah, the media has a little bit of an influence in the way that they report those data points, but in a lot of cases, like people have made up their own worldview of what is happening in the housing market based on like anecdotes and conversations that they hear. I mean, you go to the coffee shop or whatever, everywhere all you're ever hearing is about the real estate market. So people, I think, very much have their own opinion, and that's what shapes consumer sentiment. It's the aggregate of all of those opinions of all of the people of what they feel the market is going to do and how it's working. And so the fascinating thing that I think, you mentioned emerging metrics or signals that you could pay attention to. I think AI now is really good at kind of like scraping and
Right.
aggregating those conversations and trying to get a read for. And this is something that we've been doing is sort of like reading social media posts, and Reddit posts and like Twitter and comment sections at scale to see whether or not people think prices are going to go up or down, or whether or not people are bullish on real estate. Um, to create a little bit of an index in that way. And we've never really been able to digest so much content and aggregate it into a data point until LLMs came out, like Chat GPT, et cetera. So there's that.
Right.
And I think the more crude, like historic way of doing that is just like looking at like Google search trends, right? So if you look at like Google search trends, like in Toronto for like sell my house fast, or like, what to do if I can't pay my mortgage or something like that. They're hitting all-time highs. So that's another kind of sentiment indicator that you could try and apply a data point to.
Yeah, no, yeah, and I mean we use ChatGPT daily, right? And like you said, we can dump, thousands and thousands of points of data into there and kind of see, what areas are performing the best, which areas are maybe underperforming, where is a lack of inventory. That would take me hours and hours and days to try to figure that out, right? So making us more efficient and making us better for both our buyers and sellers. Now, in your view, what's the single biggest lever, whether that's policy, interest rates, migration, if that's, super big in your market, that could flip the narrative in the next 1 to 2 years in Toronto and even across Canada? And what early signs will you be watching to know which direction we'll go?
I think the biggest one, like that I'm paying the most attention to right now, is with OSFI, the Office of the Superintendent of Financial Institutions, and they're running two stress tests side by side right now. So we have the original stress test, the B20, which people are familiar with. That's where if you want to buy a house at like a 4% interest rate, you get stress tested at your interest rate plus 2%, or 5.25% if the rate's below a certain threshold. So the minimum that
Right.
you're qualifying at, minimum qualifying rate, is 5.25%. If
Hmm.
they get rid of the minimum qualifying rate, the buying power of the market would increase substantially.
Right.
Like right now, your best fixed mortgage rate is 3.5%, and yet people are getting stress tested at 5.25%. And so if you were to stress test them, or if you were to qualify them for their mortgage at 3.25%, their buying power would increase by like 10 to 15%, depending on the borrower. Um, that and it's not to say that that's something that, like, on my wish list or anything. It's just actually being studied right now. Like OSFI is running two different versions of the stress test. So they have one that's stress testing borrowers, which is the existing one that we know what it looks like. And then they have one where they're stress testing the banks based on criteria where the banks have to keep their loan portfolio of new loans under 450 times, or 450% loan to income. So you can only borrow 4.5x your income
Right.
across
Right.
their whole portfolio. It's not on an individual borrower basis, but it's across their whole portfolio. Um, and basically, if the results of OSFI's test yield comparably positive results as the borrower-based stress test, it's not unlikely that they reduce or in some way scale back the stress test to make it better for borrowers. So to me, that's probably the biggest potential catalyst. It probably could add the most change in the market. And it's probably the most likely thing to happen on the policy side to change the market in the next 365 days. I think after that, you've got maybe the foreign buyer ban. They let that expire in
Right.
2027. It would
Yeah.
surprise me. But yeah, so those are really probably, I don't think there's much more than that. I mean, interest rates, you know, pretty pretty blunt tool to repair the housing market. I think we know what the path of that looks like. We've seen, a year ago when the first rate cuts started happening, realtors told us that it was going to send prices to the moon, and it didn't necessarily happen. And so now we've seen several hundred basis points of cuts, and we've got maybe another 75 basis points ahead of us, and we sort of know what that's going to accomplish. But if the stress test goes away, now all of a sudden every single cut actually materializes an improvement
Right.
in buying power. Right now, like, you're cutting below the stress test rate, right? So we cut, and it doesn't improve the borrower's buying power.
Right.
All it does, so
Right.
it doesn't change the housing market at all,
Right.
right? It'll change the business environment and other types of credit, but it doesn't really have any impact on the housing market without the stress test being removed.
Right. Okay. Yeah. I mean, that's fantastic to know. The last thing I just had, just because you touched on it in terms of that foreign buyers ban, for us in Victoria, we didn't really see a lot of foreign buyers coming in here when that ban first got enacted. The people that were affected were 1.56% of foreign buyers. So are you seeing that affect the Toronto market more, the Vancouver market more?
Um, Yes, yes, because we have a lot of foreign buyers and Vancouver does especially,
Hmm.
but no, because there were already layers of preventative measures done at a provincial
Right.
level before the national foreign buyer ban happened. So in BC, they put in the non-resident speculation tax in
Yeah.
2016, which basically
Yeah.
made it, if you're a foreign buyer, you're now paying a 15% premium on properties. And
Exactly. Yeah.
Ontario followed suit in 2017 with the non-resident speculation tax. And so, your foreign capital was already sort of on the way out. Plus, I mean, the primary, and this has changed a little bit, but back then, the primary source of capital that was buying Canadian real estate was China. And now China also put their own independent capital controls on how much money people from China can move out of China to buy things in other countries. And so that also had an impact. And then we have far more capital. Like our biggest source of foreign capital would be India, and then you
Hmm.
also have Iran. Those are the big three in Canadian countries that invest in Canadian real estate. And there's a lot of demand, obviously, from India and from Iran as well, given like politics and stuff happening there. So um, I think that the ban, if it gets lifted with those changing dynamics, could probably actually resurrect quite a bit of activity. But I don't know if when it was implemented, it actually did that much because I think it had
Right.
already been crushed by the taxes. And yeah, most of our foreign investment was coming from China at that point.
Right. Yeah, the snowball was already rolling. Well, I mean, that's all the questions I had for you. So I very much appreciate your time. For those of you that are watching, I'll put all of Daniel's social media and contact info down below. Please feel free to reach out to him. Definitely follow him on all platforms. As you can see, he's a wealth of knowledge. So Daniel, thank you so much for your time, and I really do
Thank,
appreciate it.
yeah, thank you, man. Thanks for having
Yeah,
me.
thank you.
And that is the video. We hope that you enjoyed it, and we hope you found it as informative as I did. At the end of this video, if you haven't already, please give us a like. And also, if you haven't already, which I'm not sure why you wouldn't have, subscribe to our channel. We try to get out some great content every single week to you, such as interviews like this, vlogs about our day in the life, or tips and tricks for buyers and sellers, trying to make you more informed buyer or seller. And if you want to contact me directly, my contact info will be down below. Also, we will tag all of Daniel's info as well. I highly recommend you subscribe to all of his platforms to make sure that you're staying up to date as well. Thank you so much for watching.